Welcome. We are live on Facebook for our Thursday Q&A. Working to try to find a better name for the Thursday Q&A. That's one thing I will say out loud. If anybody has any suggestions, please let us know because I'm getting bored of the Q&A. It sounds a little cold to me, so I want to do something a little more fun. As usual, we have arranged for an incredible guest this week. This week we have John from Raymond James. Sorry, I almost said John Francis. That's not what I meant to say. John and Francis usually is with you. John Francis is your partner, but John from Raymond James has 25 years experience in the industry, and they're trusted experts when it comes to building and protecting wealth. John happens to be a certified financial planner and fellow of the Canadian Securities Institute. And today we're going to share some safe strategies that are helping clients stay afloat in this market, in this world, in these changing times with a lot going on. Welcome, John. Hopefully that was good enough.
That was beautiful. Thank you.
It's always kind of a crapshoot. We never know where it's going to go, right? And I never know. I try to read, but then I don't want to read. It's a whole thing. John, listen, let's get right into it. We got 30 minutes to get this done. What is happening? Like, why should we care what's going on?
Well,
And what's kind of like the foundation for a good strategy right now? Like, what are some of the things we need to think about?
well, I know what we are thinking about right now.
Yeah,
Whether we should be thinking about them or not is another matter, but
that's a great point.
certainly top of mind is Donald Trump. Donald Trump, Liberation Day, and all the tariff policies that are impacting everyone around the world.
Fair.
Uh, that was dramatic. If anyone was watching markets or opening up their statements, or especially if they made that what I think is a critical mistake where you have your accounts available to you online, and you can go in day to day and look at your balance. If you're doing that, Liberation Day and what happened afterwards was kind of shocking.
Yeah, you would have
You
been
know,
looking at a graph that was not favorable, I imagine.
Yeah, absolutely. And I think that largely led to some political change here in Canada, right?
Hmm. Hmm.
I think a little surprise change in where leadership was going.
Hmm.
Um, Markets have been very volatile. Is the economy going to slow down? Are interest rates going to go up? I mean, Justin, housing, what's going on with this housing? How do people make long-term decisions
Right.
with so much uncertainty?
Yes.
Um, Interest rates, inflation. Is inflation going to come down with such tariff concerns? Seems like inflation could be more of a problem. And so I guess one of the things that I'd want to point out is when we're in times of chaos like this, uh, we can't help but start to think, my goodness, this time it's different.
Mm.
This is different.
Hmm. It
And,
certainly
and
feels different than it did last time when Trump was on board. Don't get me wrong. I would tell people back in the day in his first term, Trump could tweet something and the markets will change. And whether it's real estate market, whether it's the securities markets, whatever, like it doesn't matter. Trump has the power now with a couple of taps of his thumb to change world markets at the moment.
Absolutely. Absolutely.
So I mean, we're finding in the real estate market, just so I bring that to it a little bit, is that I think a lot of people are sitting on the fence. So you've got a lot of people listing their house going, well, let's see what's going to happen. But a lot of buyers going, well, I want to wait and see before I make that move. So under the assumption that the sellers that are out there now, which there's a lot of them, when they sell, they would buy. There's plenty of inventory for them. The buyers that would typically potentially buy those houses or are that don't have their house listed now are waiting. And that
Yeah.
waiting is to see, I think, what would happen with our election, which is done and gone. And
Yeah.
quite frankly,
Yeah.
no matter who you voted for, I have to say out loud that I was quite proud of our current leader down in Washington, D.C. this week. I thought he did a
Uh-huh.
hell of a good job,
Yeah.
uh, you know, uh, standing up to that guy. I don't know how you feel about it, but that's how I feel.
They are.
And I really do believe that that was one of the precipitors. And then to see what happens with, I think I liken it to the gas prices. Gas prices go up and everyone freaks out, and then at once we see like a bit of like we all sort of settle into it. So everyone freaks out at first, they don't know what to do, then they settle into it. Is that kind of the mindset that you're seeing happening out there now?
Well, we're trying to, when working with clients, your intro was great. We're looking at helping people make smart decisions,
Right.
stewarding their wealth for the long term.
Right.
I'd love to have some answers to the questions and the uncertainty that were put out. And certainly there's lots of information and opinion out there. I guess some of the things that I think we're going to get into maybe have more to do with a little bit of wealth management wisdom. And I guess the first point that I would make, that while there are all these risks out there, no one can figure them out in the short run. No one can analyze the current state of affairs and make some decisions. So in your world, very important, obviously, when people are making a very large, probably the largest asset class they own is their real estate.
Yes.
And for many people, that real estate decision isn't quite simply an investment.
Mm-mm.
It might be a beautiful long-term investment, but it's also a lifestyle decision and a
Mm.
life planning decision. And so, yeah, that's your areas of expertise in helping them make and guide them through that decision. In our world, though, these assets need to weather the storm and fund a retirement lifestyle, leave a legacy, fund charitable interests or things that folks that touch their heart. What do we do throughout all of these times of turmoil? First off, recognize this time is never different.
Mm.
There's always going to be chaos.
Mm-hmm.
The specifics that started the chaos, they're all different. Tech wreck in 2001, the housing crisis in 08,
Mm.
COVID. The catalyst is the same, but the panic-driven markets that people sometimes are predominantly invested in, obviously, if they're investing in RSPs and TFSAs, they're going to have some equity exposure. That's usually panic-driven. So
Are
we
you
got to help
saying
people.
basically don't panic at this point?
100%.
I got
It's
honestly like that feels like what you're saying to me, right? Because there's two pieces. You're mentioning long term. You're not most people that invest with someone like you, especially you guys, from everything I've learned from you guys over the last several months of our relationship or a year or so of our relationship, is you're shooting for the end goal here,
Oh,
not
absolutely.
tomorrow.
Justin, Justin, when we take in a lot of information and we take in a lot of media, we get myopic. It brings us into a tighter and tighter lens. What's going to happen when the tariffs get reversed? Or what's going to happen when there's a policy or an agreement or this or that? And what we're trying to focus to, and the problem with getting myopic is that we often make emotional, rational, irrational decisions
Mm.
about things that we can't figure out. So humbly admitting that you can't figure out the short term is really a wise thing. We want to take people back, step back and say, do I have good reason to believe that this crisis, like all the other crises, will work themselves out? I don't know how they're going to work themselves out.
Mm-hmm.
I don't know when they're going to work themselves out. But given the historic record, I have absolute certainty that they will work themselves out. And in a number of years, we're going to be looking back and saying, "Oh, hey, I remember like that Trump guy and all that crazy talk about tariffs and everything." We're going to look at that, look back, and it's just going to be like when I look back with clients throughout the market's reaction to COVID. It's we remember it being scary, but we're so far beyond it and so far above it in our investment world. And so every single crisis it starts with something different, but it's fueled by panic. We recover, we move on, and we go higher, and it's a blip. And it's my job as a let's call it a behavioral investment counselor, a coach,
Good
um,
point.
a coach, a planner, to try to bring that perspective and to take away a little bit of the emotion.
Do you get panic calls from people sometimes where they're like, "Hey, what are we doing?"
Justin, I've been getting that question from some clients
Yeah.
and other folks. They've been asking me how our team is doing. Adam Bansky, Francis Holman, and I work together in a team,
Yeah.
and we focus on three key things that we think are really important, the three
Sure.
keys.
Sure.
And clients and people ask me that question. The truth of the matter is we haven't got a lot of incoming calls. Our clients aren't panicked.
Because
And
of
it's
the education piece that you guys put together already.
I believe that
So knowing that they have a relationship with you and going through the process of what you teach them, you're not getting as many of those calls, if any at all, because people are very comfortable knowing that they're in good hands.
it's a muscle.
Right.
It's a muscle. And you know what? All of us have been pretty fortunate to work that muscle more than we want to work that damn muscle in the last 10 years. With COVID and other crises and this thing coming along, we don't want to work out this muscle, but we recognize that these sorts of panics, they're going to happen.
Yeah.
We are going to have uh, pullbacks in the market. We are going to have bear markets. We are going to have recessions. They are just the way markets work. And we have to have a sound foundation to work our way through them. So it's not when will there be a bear market. It's not when, if there'll be a bear market or if there will be a recession. There will be.
When.
And
Yeah,
what
it's
are we
when.
doing and what's the foundation we've laid just to survive through it so we're not panicked? Sorry.
So sitting in the moment we're in, are there any risks we should avoid if we're starting today or opportunities that we can look at starting today?
Well, I think risk can be looked at in a number of different ways. And I think quite often in our industry, when people talk about risk, but let's just the typical risk that an individual investor faces often is thinking about, if I put my money in something, am I going to lose my money?
Right.
Yeah.
You get some advice from the neighbor and they give you a technology stock or a mining stock, you put your money in it, it goes bust, the money is gone.
Mm.
That's one kind of risk. That's a risk that we can completely eliminate by properly putting your money in many different baskets and hopefully not listening to your damn neighbor because this isn't their profession. The second risk that our industry tends to focus on, and I want your listeners to think about this a little bit, whenever they've worked in and have gone to a financial institution, probably if they've engaged someone, they might have filled out some kind of questionnaire. It says, how would you feel if this happens? How would you feel if this happens? Would you like that to happen? There's a bunch of boxes you check. And the goal there is to try to assess how much ups and downs or volatility are they willing to accept to keep them comfortable? Well, it's volatility risk. We don't like things moving up and down. I get that. But there has to be a trade-off with the third risk. And this is the biggest risk we all assume. And it's not often talked about when we engage with people as in an industry. And that's the erosion of your money's purchasing power over time from inflation, taxes, and sometimes fees. This is the biggest risk someone faces entering a possible 3-decade retirement. And if we just focus in on volatility risk, we can put the other risk, we can compromise addressing that other risk.
Mm.
And so we need to have a financial plan in place.
Mm.
We need to have a financial plan in place. I know it sounds all basic and everybody knows this, have a plan. But I'm telling you, if you attach some emotional, tangible, heartfelt life planning goals to this exercise, where this exercise becomes, this is what I really want to achieve for myself, my family, and my legacy. Starting with goals that you planning work could be very simple, could be more complex. A plan helps us figure out, well, what does the money need to do? What rate of return does it need to earn? And that third risk, that if inflationary risk, needs to be baked into that planning work.
Mm.
You know, what does the money need to do? And more importantly, what does the investor need to do? What are the disciplines they need to have? So planning's number one, and then risks and return, that's all satisfied with that kind of, that second key element that we talk to people about, asset allocation, and certainly being properly diversified.
So this is like, I mean, we've talked about this before. You have these three key principles: planning, asset allocation, having the if we're not, it's the
I
same in
hate
real
that.
estate.
I hate that word, Justin. If you can give me another word for asset allocation and diversification,
Yeah,
I'd love it. It sounds awful, but it's critical. Sorry,
it's
yes,
very
in real,
technical. I will,
yeah,
you know. But so those are the first two. I mean, we talked about these three key principles before, and I want to hammer this home because this feels like kind of like your signature process for what you guys do. And the third one tends to be, you mentioned before, something along the lines of investor behavior.
absolutely,
So
absolutely.
this is kind of back full circle to the beginning, which is when shit hits the fan, we don't panic.
Yeah, yeah, but and that's not easy to do.
Mm.
So, you
It's
know,
not easy to do, John.
it's
Well, because
not.
you can watch your numbers just click, 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 down,
Well,
down, down.
well, and
By the way, welcome, Karen. Thank you for showing up.
I saw
Sorry.
Karen, I saw you pop up, and I wasn't sure if I should say hello to you. I don't know how this whole
no,
podcast thing
Very
works.
loosey goosey.
I was having a dilemma with my name at the bottom because it was my daughter's name instead of mine, and I'm not sure why that came up. But anyway, so it's not, because I think at the very beginning when I was when I was had a family and I was saving money, and I found, sorry, I have to, investments, investing very restrictive. It restricts you in regard to, oh my God, I want to do this. And then the investment is there and it's sort of, oh, well, I don't, I shouldn't be taking that out. And, it's kind of interesting, John, because a lot of people are, I guess you've got to be very, very, how can I say it, very tight with your money if you want to invest properly at the very beginning.
Yeah, well, it's setting up some disciplines. So for the Justin, you brought up the concept of that third key, which we think is pretty important, that sound investment behavior. Karen, at the very beginning, we got clients, not all the time, but frequently three generations of clients. And what the young person just starting out saving, investing, and doing, the disciplines that are important to them or that we need to emphasize are obviously very different than the client who's well into retirement and using these funds to
Yeah.
secure a lifelong retirement. But that goal piece, the planning piece, behavioral, hugely important. Asset allocation, this is the technical piece, but we really, there's kind of I would submit four major asset classes that people can own. And the first one is your area of expertise, obviously, is the real estate piece.
Yeah.
Often the biggest piece. In
Mm.
our area of, RSPs, save, our RIFs, TFSAs, investment accounts, corporate accounts, it's those other asset classes: cash, bonds, and stocks. Now, how you invest in those things, we're not getting into that today. We're not going to talk about products and things unless you
Yeah,
want to do a
yeah.
little of that. But, I want you to think of three different numbers: 10, 6, and 3. That's the long-term rate of return of stocks, broadly diversified annually. Long-term rate of return of bonds. We can't get 6 on bonds now, and 3 on cash. So when we're looking at building that plan and talking about behavior, obviously the bonds and cash have less volatility, less ups and downs, there's less emotion to them. But now I want to take that 10, 6, and 3, and I want to back off another number. That's the 3. That's the long-term average inflation rate. So net of inflation, your stocks are now only giving you 7. Your bonds are only giving you 3, and cash is giving you 0, if that. So it's this trade-off between having the right allocation that protects your purchasing power over a long time and keeps you comfortable throughout all the ups and downs.
That's really interesting because we have clients, Karen, you know them, a few of them, that used to put money under the bed.
Yeah. Oh, yeah.
You know what I mean? Like, we've heard this story before.
They
Like,
put
that
them in
literally
the,
happens.
you know, they're you know, under their bed, and the cash is, you know, all over their house, etc. But the thing is that I think times have changed, and the interesting part about that, and John, you know that I'm older, I'm a senior, and when I was younger, I used to sock away money like you never believe, RSPs, right? And TFSAs were non-existent, but RRSPs, and I used to sock it away. And then I got a divorce, and that you know was quite devastating. But the financial advisor that I had, you know, they weren't as educated. They didn't want to get to know their clients' personality, or because what you're saying to me, and I find that really, really great, is that you get to know your client. And okay, so what do you want to do during your life as you're saving for your retirement? And because if I had come to you, I would have said, well, you know what? I want to travel the world. I want to kayak. I want to do this. I want to do that. And so how can I do this and save money? But no one ever
Hey,
asked that.
hey, Karen, let me ask you a question. Is cutting back on the money you spend today and saving, is that fun? It's not fun.
No.
It's not. No one
I
wants to
love
do that.
spending money.
Of course we do. Consumption today is far better and more enjoyable than consumption later. And I guess planning is really to try to help people put a balance between an educated plan to say, you know what, like, can I do what I want to do today and enjoy everything and not compromise the future? So it's just that. It's
And
just
that's
that
a good way of putting it. That's a beautiful way of not
life's now.
compromising the future. In other words, when you're, you know, in your senior years, you're not looking at, oh my God, how much money do I have left when I'm 100? I'll be working on the and
I'm gonna bet most of your listeners, most people don't have a written financial plan.
No, I don't think so
Okay.
either.
You know, and the thing is, there's times when we've met with people, and I'm going to encourage them to do that. Do a financial plan, because here's the thing. We meet with folks that come in often, maybe new people, they're approaching a landmark like retirement, or they're just retired. It's like, okay, we just went through a 19% pullback in the market. I want to make sure we're okay. We go through the planning work and we realize that they haven't enjoyed their today or their yesterday or the last 5 years to the extent that they could have. They've been saving and worrying too much. So it's not all about, oh, you know, nose to the grindstone, save more money, save more money. Often it's a little bit of freedom and liberation from, hey, we're good. We're good. We can take a little bit of a breath. And, you know, if I asked you, if the goal is to fund a long-term, worry-free retirement with no compromises and no fear of ever running out, that's one goal. That's a goal we try to help people flush out. Things like that versus the other goal. I want to earn 10%. I want to beat the market.
Yeah.
I think it's very important that planning piece, getting that right allocation, keeping in mind the biggest risk is inflation, not volatility. And lastly, behaving well when everybody else is losing their minds and markets are panicked and up and down. We've got a firm foundation of history to know that if you stay the course, have a little bit of cash, a little bit of bonds, diversify your equities really well, diversify them, Canada, US, international, and then periodically do the opposite of what everyone else is doing. And the opposite of what everyone else is doing is they want to sell their losers in that big mix and buy more of what's working. No, no. We want to do the opposite. We want to take the things that have done the best and trim them back, not abandon them, and buy the stuff that's on sale. And that's those three keys. If we just do those three things, we assure success. How we invest, that's different for everybody. We have our style, you have your style. But if we can do those three core things, I think we've assured people's wealth management success.
And stop reading the
over a long
headlines.
time.
That's the fourth thing.
There we go. Sorry.
Because you had mentioned, I mean, we're talking before. Sorry, Karen, to cut you off a little bit.
Yeah.
You mentioned before, but like the drop after the tariff situation and what you would call Liberation Day was significant, but it was a very temporary, like we didn't see, like most of the markets have come quite a bit back at this point.
Absolutely.
And we're talking like weeks later. It's not like this devastated people for 10 years.
Well, we're in the age of technology now. So technology has made this world much faster. Much faster.
I was just watching a movie the other day and I can't remember what it's called. It has Jesse Eisenberg in it and he's trying to dig a line from Kansas to New York. Have you seen this movie? You're an investor guy. You'd like this movie. It's about the idea of he's trying to save 1 millisecond in time by drilling this line from Kansas to New York so that he can get investor data 1 millisecond faster than everybody else to be able to buy it for a little bit cheaper and then resell it 1 millisecond faster. This world moves at warp freaking speed right now.
Oh yeah. It's
right to your point, Karen. And like everything's happening very fast.
Yeah.
And things react very fast. So Trump makes a statement or sends out a tweet, boom, things go down. You know, everybody realizes, oh, it's not that bad. Boom, things go back up.
you know, how is, you know, and that's kind of interesting because you're right. The markets went down, they came back a long way.
Yeah.
But I want you to think about how is a price established? How is a value established in a neighborhood? In a market that you deal with, a transaction takes place, right? In the past.
Yes.
Transaction. So when we see that chart after that panicked announcement and we see the price go down, what does that represent? That represents actual transactions.
Yeah.
Right.
People actually selling stuff.
Right.
Down 20% or 19 or 10 after that moment. And that often is a panicked move, right?
And then when Donald Trump said, oh, it's a great time to buy because, you know, the stock market had gone down. And so all of a sudden in the next week, everything started going up again. And, you know, he's you know, I have a very serious question and I know we could go on and on, John. I love talking to you like this. So I meet a lot of people that have mediocre savings, very mediocre. I'm talking, you know, 25, maybe 100,000, maybe, you know, and what happens is they look at me and they say, well, we want to sell our house because we need the asset to get out and to rent and to do this. Now, and these are people that maybe are in their 60s. Some of them are in their 70s because I meet a lot of those. So do you get people who come to you and say, hey, you know what? How can we make our $25,000 or $100,000 grow? Because not everybody's a millionaire. Okay.
No,
And you know, I don't know what the percentage is out there because they never talk about that. They always talk about the millionaires and billionaires, and we're sitting there going, okay. But so how do you help those people if they do come to you? I mean, maybe they don't even come to you because they're intimidated.
No. We love working with a broad range of clients. I mean, as I mentioned earlier, we've got, you know, clients who have who've referred children and grandchildren. They have different amounts. We have different amounts of money. But I think these foundational principles are true for everybody. And so does, if the person is approaching retirement and maybe they're house rich and investment poor, well,
Yeah.
we gotta look at, okay, how do you use what you
I meet a
have?
lot of those. You know that, John? I meet a lot of those.
Absolutely. Do they, should they stay in that? Should they stay where they are? Like, do they, is their balance sheet too heavily weighted? Maybe they need to downsize.
Mhm.
Maybe they need to use some of that equity in their home to produce a cash flow, a pension fund, use some of that. And that's all where the planning kind of comes down, just sitting down and listening and finding out what's important to you, important to a person in that perspective, in that way. But the foundations are kind of the same. We got to have an asset allocation that funds the plan and addresses that biggest risk that's out there, that's inflation.
Mhm.
And then behave well through ups and downs. So yeah, the smaller accounts, well, the solution that's implemented, might reflect, what do you do with $100,000? The solution for a $500,000 account is going to have the same themes, but maybe be implemented in a little different
Yeah.
way.
Yeah.
And the $5 million portfolio is going to have a little bit more complexity, but still share the same themes and beliefs
Mhm.
that $25,000 portfolio it has. And that is, I'm not smart enough to figure out where the next best place to invest is. I'm not smart enough to figure out exactly what areas to avoid.
Mhm.
We have a beautifully diversified mix. Never have too much money in any one place to either make a killing or get killed. And then just steward behavior in the context of a plan. It's simple, but it can be hard because of all the information that we're pumped out at us.
It sounds the same as a lot of things. As a kid, when I was growing up, I played baseball. And all I was ever told was, and we joke about it now with the boys, my boys, we talk about the fundies, the fundamentals, right? With hockey or baseball or sports, right? There's fundamentals that you need to know and practice every single day. And those things will help create the larger picture of success. One day, when you're up at the plate and you're using those fundamental options, those fundamental pieces, you might hit a grand slam home run. Another day, you might hit that same thing into a double play and get out of the inning. It's going to balance itself out in the end, but the point is that the fundamentals stay the same. And what I
Yeah.
like about what you're talking about is that, and I think too many investment people and investment strategies and, you know, advertisements on TikTok and Facebook and some of these places talk about these get rich quick
Yeah.
schemes
Yeah.
and the opportunity. Invest here now, you're going to, you know, and this really feels like a careful, calculated, um, cautious yet also aggressive in a way when need be way of doing this that creates wealth for you long term, which almost wherever you are in your life cycle, whether you're, just getting out of university or you're walking into retirement, it's the same thing in a way. Like you're looking for the same structural foundation to be able to create that stability. And I guess that's the word of the day is stability, because that's what you want. You want to be able to take all these waves out and just have that stability to feel comfortable and not ever have to make a call to John because he knows what he's doing.
One of the things that we look at, I mean, owning them. We own equities for the long term. We own equities for their dividends, their earnings growth, and their growth in values, because that's a key weapon, or pardon me, a key defense against inflation.
Right.
So we've got to own those, but we have to recognize that they are volatile.
Mm.
But the volatility is not a problem. The volatility is why they have to pay us a premium over other things. If equities weren't volatile, we can't earn a premium over inflation.
Mhm.
So the smart investor, we don't enjoy it, but we look at volatility as an opportunity.
Mhm.
And when things went down 10 to 20%, that was an opportunity to do exactly what I said before, without any preconceived notion or prediction or without any forecasting, just with a sober, calm mind, sell the stuff that was a little overvalued in that allocation and buy the stuff that was undervalued in that allocation. What could be simpler?
Yeah.
You don't need to be an economist. You don't need to have a forecast. You don't need to have an answer. All you need is a framework and a structure and a policy and execute.
Yeah.
And that's
So one of the emails that I got at one point was really funny because a company, not a company, I can't remember what it was, but anyway, said, flashing in my face and with an email saying, "Oh, with AI you can invest and they will read the stocks for you and you will make a lot of money." I thought, wow, that's very tempting.
So who's liable for that when all the money goes away? I don't know.
Nobody.
Just saying, the AI is going to pay you back or what?
Oh, I thought it was hysterical. I text my brother in Montreal, who's he's a big player in the stock market, and I said to him, "So I'm going to invest $1,000 in AI and see where it goes with all, because they say that they're going to bring back a lot of money." And he said to me, "You're nuts." He said, "Don't you dare."
Well, I don't know. I don't know. I mean, it might be fun for $1,000.
Yeah, it's a game,
That's where it becomes a bit of a game. Yeah,
And
AI can't have, and I know I'm kind of pumping our own tires here.
That's okay. That's what we're here for.
We feel that the advice, just like you guys in your business, when it really, really matters, a big real estate transaction or managing your family's wealth or your pension plan, you want an empathetic, but sometimes tough loving advisor, right? Sometimes you have to coach and you have to move people to help them make a right decision with empathy. And you know what? AI, some bot, some formula isn't going to sit across the table. And I think when it really matters, like in life events, like what we both deal with in our respective industries, that human piece, the confidence is critical. And, the technical piece, there's lots of different ways to invest. Maybe the bot has an algorithm that works great, but the bot doesn't help the person when they're panicked and they're susceptible to what we call the big mistake. And the big mistake is, get me out now. I'll take whatever price for this house. Just sell it.
Yeah.
Just get rid of it. Like, that's capitulation. And that can really hurt the long-term viability of their obviously their housing or their pension plan or portfolio.
Yeah.
All right, I'm all over the place here, guys.
No, that's okay. That's the point. It's just a discussion. We have our questions and then who knows where it goes. Right. It's this is the idea we're just real people asking these questions because we don't know any better.
Well, I think what it comes from the fact that we deal with a lot of people. We actually get a lot of questions in regard to financial advice. And I always turn around and say, "Do you have a financial advisor?" Because that's where, that's where you guys come in play and your name is handed in. But the thing is that when we get these questions, if we have a Q&A like this, we can then ask the questions that they're asking us, and it's quite interesting because it's real life. We're on the ground.
But I do find it interesting how our two professions sort of mimic each other in a lot of ways. Because I did read somewhere that there are other countries on this planet that don't have the same mindset for real estate that we do here in North America. Real estate isn't an investment in certain countries. You own the property and you own the house and you build whatever you build on it, but it's not treated the same way. Henceforth, why values aren't skyrocketing in certain countries and things. We have a very unique scenario in North America whereby real estate can be an investment vehicle, which allows you to increase your funds and make money.
Oh, it is an investment.
incredibly unique, but it has a unique feature in most of the in portions of
Well,
the
that's why they're offering the mortgages now. Not mortgages, but the what's the when you get financing on your house and you don't have to pay it back and it grows with your
oh, the reverse mortgage.
reverse mortgage.
Yeah,
You know, you can, I mean, because these companies have recognized that that real estate is an investment.
there's value there. Yeah.
Also, when you deal with someone like John, who is very knowledgeable in the market, and I find him extremely knowledgeable because of our last chat that we had at that meeting. It was, you know, it's incredible because some of the issues that are some of the things that the average person doesn't know should come forward more so than, you know, it's all about knowledge.
So to summarize all of this,
Are we summarizing now?
we're summarizing because we got to go. Okay, we're over the
Yeah.
30 minutes now.
Oh, we're over.
But there's one other question.
I made it. I made
You
it.
made
No,
it.
please.
Yes.
Karen,
Karen,
yes, what's
ask
your
your last
There's only
question
one
and then we'll
question,
summarize.
one more small question. So TD, I see on television, has this young girl who says, "Oh, I can invest partially." So now she can buy a partial stock, and she
Oh,
walks
yes.
around. Did you see that?
I've seen that ad. Yes, I know which
Yeah,
one you
the
mean.
commercial. That and so is that feasible now in the stock market that you can buy a $5, you know, a $5
A
investment?
fraction,
A fraction.
a fractional ownership. Yeah, I just, for me, I just don't know why we would ever need to do that.
Okay.
Well,
fraction.
it speaks to a certain type of client, right? That's what they're
The
going
young
for.
people. The
They're
young
going
people.
for new people that don't know and don't have a ton of money right now.
Yeah.
And they're looking for a very specific client to get them started in the investing game.
Yeah.
And part of that is probably driven by the idea that Bitcoin, for example, and those types of things, they started doing fractional investments in those things when Bitcoin became
Yeah. Yeah.
$60,000 and no one's going to buy
But-
one Bitcoin.
But let's, just to push back a little bit, I know you want to wrap it up, but you can buy the 500 largest companies in one basket, right? You can, that young person with not a lot of money. Now, when you buy a fraction of one share, you're believing that you've picked the right company.
Right.
You
Right.
haven't diversified. You're
Good point.
probably speculating, right? I like this company. It's like, okay, it's great that we need to have access for different amounts of money. But what behaviorally does it say? It kind of says, oh, I'm speculating a little bit here. I'm going to put
Don't kibosh the whole idea.
I'm going to kibosh it. I'd like you to own hundreds of companies and never ever sell. Own them, own stocks and equities and businesses, own them, don't rent them.
Fair enough. So to summarize, plan for your future. Make sure you have the right plan. And John can help you with that. John and his company can help you with that.
Yeah.
The second thing would be asset allocation and diversification. Make sure you're allocated and diversified perfectly, or at least somewhat perfectly.
Yeah.
And then keep calm and carry on.
There we go.
Right? Don't let the headlines sway your decision making.
Oh,
And,
don't
and
don't
stay
even
calm and
listen
make
to the news.
real decisions and if you need help, ask. I made the mistake, and I'm going to tell one last quick story before we go. I made the mistake in 2007 of thinking to myself, I'm going to buy with $5,000. I'm going to buy a bunch of shares in a bunch of companies, and I'm going to pull the share certificates out, and I'm going to hold on to them forever.
Yeah.
And it was funny because it was 2007 when I did that, like early. And we all know what happened after early 2007, which was essentially the housing market crisis in the US, and the world went boom like this. So all of that $5,000 turned into $1,000 really quickly. And so I still have those share certificates hanging around.
Good.
And which is cool. I was talking to another investment person the other day, and I told him that, and he's like, "You have those? They can I see them?" Like, it's like a big deal because nobody has those anymore. It's really cool, actually. And so the point being that it's good that I did that, and it's cool, and I'm going to hold on to those. But what could I have done with those? Well, I could have called someone like John and taken that $5,000 and probably done something a lot more effective than what I did with it. And I'm not like, I'm fine and I'm happy and I'm comfortable with what I got. But having the professional advice that John and his team bring is far more important, I think. And I'm speaking from, like, if you're coming to real estate, come to us and get that advice too. It's far
Absolutely.
more important than just going it on your own, because you can't know everything. And like, I don't change my own oil in my car because I don't know and I don't have time to learn it. Right. So I'm going to call John.
When
I'm
it's
going to call.
really important, like your advice on your home, on your real estate transaction, on your pension, on your plan, you need advice.
Advice.
Absolutely.
Agreed. So we're going to put all John's links in the captions below, in the comments below. Make sure that you can reach out to him some way, somehow, if you need him, with one
Thank you.
quick click and get it right into his inbox and be able to reach out. So thank you, John. We very much appreciate your time
Thank
today.
you.
You are way smarter than me somehow. And
No.
I'm pretty
Thank you,
smart.
John. Thank you.
Thank
Very
you,
good.
Karen.
Thank you.
Justin.
Yeah.
All the best.
Bye.